The Trump tariffs are officially live, and the stock market is already feeling the pain. 25% tariffs on Mexico. 25% tariffs on Canada. Another 10% on China, on top of last month's tariff. And just like that, the stock market dropped. But here's the big question: how bad will this get? Will the economy slow down? Will inflation surge? Or is this just another short-term market panic that could create massive opportunities for investors? In this video, I'll break down what these tariffs really mean for the economy, how they're already impacting the stock market, what this means for your investments, and how you can profit from the chaos. Make sure to hit that like button and subscribe so you don't miss future updates. Let's get straight to the facts. President Trump just signed these tariffs into law. 25% tariffs on Mexico. 25% tariffs on Canada. A new 10% tariff on China, on top of last month's 10% tariff. And guess what? Canada, Mexico, and China are not happy. Here's how they responded. Canada's Prime Minister, Justin Trudeau, called the tariffs a dumb thing to do. Canada retaliated with a 25% tariff on U.S. goods, starting at $30 billion and possibly going up to $155 billion. China announced new tariffs up to 15% on U.S. agricultural goods, specifically targeting soybeans, beef, chicken, and pork. Mexico hasn't announced their exact tariffs yet, but they're expected to hit back on Sunday. This is turning into a full-blown trade war, and the stock market did not like it. So, why did the stock market react so badly? Small Diamond Best Buy's CEO just revealed that 55% of their products come from China and 20% come from Mexico. Small Diamond, that means 75% of their supply chain is now facing tariffs. Small Diamond, their costs are going up, and it's literally impossible to know how much consumers will be affected. Meanwhile, Target's CEO said these tariffs could cause price hikes as early as this week. Fruits, vegetables, electronics, everything could start getting more expensive. And that's why the stock market is freaking out. Tariffs are essentially a tax on consumers. If companies can't absorb the cost, you, the consumer, will pay higher prices. To understand the impact of these tariffs, let's look at what we import from each country. Mexico: cars, produce, and auto parts. Canada: cars, lumber, machinery, and plastics. China: a massive range of goods, from electronics to clothing. That means if you're buying a car, groceries, furniture, or even a smartphone, you're likely going to see higher prices. This could fuel more inflation at a time when prices are already high. Why is Trump doing this? There are two main goals. Trump has suggested that these tariffs could replace income taxes in the future. The idea is to use tariffs as a tax on imports instead of taxing American workers directly. Will this actually happen? We don't know yet. But Trump's 2026 tax proposal suggests big cuts, and the government needs revenue from somewhere. Trump wants to make it more expensive to produce goods in Canada, Mexico, and China. If tariffs make foreign production too costly, companies might decide to move their factories to the U.S. instead. To encourage this, Trump is also proposing tax incentives for companies that manufacture in the U.S. But here's the risk. If companies can't move manufacturing quickly, they'll just raise prices instead. There are two big concerns with these tariffs. Keycap 1: higher inflation. If companies pass the extra costs onto consumers, prices go up. That could make life even more expensive, especially for food, cars, and electronics. Keycap 2: potential recession. If businesses can't afford higher costs, they might lay off workers or cut spending. If spending slows down, economic growth could stall, and we could see a recession. And that is why investors are so nervous right now. The market saw a knee-jerk reaction to these tariffs. But should you be panicking? Here's what smart investors are doing right now. Keycap 1: looking for safe havens. Gold prices spiked as investors rushed to safety. Real estate also hit new highs, according to the Case-Shiller Index. Keycap 2: watching key stocks. Companies that rely on imports, like retailers, could struggle. But logistics and transportation companies might see a boom as supply chains shift. This is why understanding market psychology is crucial. Remember what Warren Buffett says: be fearful when others are greedy, and greedy when others are fearful. Markets go up and down. The real money is made by those who stay calm and look for opportunities. Here's how to navigate this volatile market. Key Cap 1: Stay diversified. Spread investments across multiple assets, including stocks, real estate, and gold. Key Cap 2: Consider ETFs. Funds like SPY, S&P 500, or VTI, total stock market, give you broad exposure. Key Cap 3: Look for market shifts. Logistics companies, US-based manufacturers, and alternative energy stocks could benefit. Most importantly, don't let emotions drive your investing decisions. The best investors see opportunity where others see fear. These tariffs are just the beginning. Expect more retaliation from Mexico and China in the coming days. So how do you prepare? Stay informed. Stay calm. Look for opportunities. Make sure to like and subscribe so you don't miss future updates.